Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, March 7th, 2023. Hope everybody's having a fantastical day out there in the interwebs. Apologize for being a little bit late. I had an appointment, showed up a little early at 2 o'clock, and did not have a chance to record my video for today. So I know a lot of y'all are out there like, gosh, I just don't know what's going on. Ray hasn't told me what's going on in the market. So pretty ugly is what I'm going to tell you. It's like a redheaded stepchild. Ugly markets for today. So, all right. If it's your first time watching, please give me some big old thumbs up, likes, shares, subscribes, all the follows, all that good crap. I'd greatly appreciate it. And let's go ahead and dive into the numbers for today. Let's make this bigger so you can see it. Come on. Cooperate with me. All right. Dow Jones was down 1.72% today, closed at 32,856. S&P 500 down 1.53, closed at 39,86. NASDAQ down 1.25%, closed at 11,530. The VIX was up 5.27% today. It's at 1959 at this moment. Canada was down 1.17. Brazil down 0.45. Mexico down 1.59. Looks like our friends across the Atlantic had just as much ugliness as we did. Germany was down 0.6. UK down 0.13. France down 0.46. Netherlands down 1.09%. Spain down 1.05%. Italy down 0.67, Switzerland down 0.75%, and Portugal down 0.22. Russian exchanges split today. The MOEX slightly up 0.06, the RTSI down 0.72. And the overnights in Asia, Japan was up 0.25%, Australia up 0.49. In the Chinese markets, the Shanghai was down 1.11, the SESE component down 1.98, China A50 down 1.17, DJ Shanghai down 1.33, and the Hang Seng down 0.33. Taiwan weighted was up 0.6% for the day. So, like I said, looks like things got beat up pretty badly. I think a lot of it had to do that Chairman Powell was running his soup cooler earlier and terrified everyone in the investment markets. So, all right, let's go ahead and bring up today's market recap. Wall Street sinks as Powell flags sharper rate hikes. Let me get my notes here. All righty. U.S. Stock indexes fell on Tuesday following comments from Federal Reserve Chair Jerome Powell that the central bank would need to raise interest rates more than expected to control stubbornly high inflation. Powell's remarks, his first since data showed inflation unexpectedly jumped in January, and the U.S. government reported a large increase in payroll jobs for the month, caused traders to dramatically increase their bets of a 50 basis point rate hike in March. All 11 major S&P 500 S&P sectors were down, with economically sensitive financials leading the losses with a 2.5% drop. The consumer discretionary index fell the least, down 0.99%. Rising bond yields also weighed on equity valuations, particularly those of growth and technology stocks. Powell, who will testify again on Wednesday before the House of Representatives Financial Services Committee, added that the Fed will not consider changing its 2% inflation target and that the job market does not suggest an economic downturn is close. Are we sure about that, Jay? The Fed will use data, including Friday's non-farm payroll numbers, to influence its rate hiking path. The yield on the 2-year Treasury notes, which best reflect short-term rate expectations, hit 5% for the first time since July of 2007. Some money managers say investors should have been expecting Powell's hawkish tone, given the strong employment and consumption data and the fact that the easy gains in the battle against inflation have been made. John Lynch, chief investment officer of Comerica Wealth Management, said that, quote, the bear market rally that had began in October has been supported by hope over reality, end quote. However, Chris Zaccarelli, chief investment officer at Independent Advisor Alliance, said that, quote, the idea of higher rates for longer is a headwind, and hearing it directly from Powell is a little different to inferring it from the data, end quote. Big individual stocks moves, including Rivian Automotive, falling 12% after the electric automaker unveiled its plans to sell bonds worth $1.3 billion, while Dick's Sporting Goods rose 9.6% after the retailer forecast annual earnings above Wall Street estimates and more than double its quarterly dividend. Declining issues outnumber advancers on the New York Stock Exchange by a 3.71 to 1 ratio, while on NASDAQ a 2.13 to 1% ratio favored decliners. The S&P 500 posted 10 new 52-week highs and 7 new lows, while the NASDAQ composite recorded 45 new highs and 122 new lows. All right. So, not great. It sounds like people were aware that the data didn't look great, and that they just needed to hear from the horse's mouth that, hey, we're not going to get low interest rates anytime soon. So, All right, next up on the docket, U.S. factory orders fall as civilian aircraft demand dives. New orders for U.S. manufactured goods fell in January by 1.6%, a decline largely attributed to a 54.5% drop in civilian aircraft bookings. However, an increase in machinery and other products suggested that manufacturing may be regaining its footing. The drop in factory orders in January mostly reflected a decline in transportation equipment, including a significant decline in orders for civilian aircraft. However, motor vehicle orders increased by 1.3%, orders for machinery rose by 1.6%, and orders for computers and electronics rose by 0.6%. Orders for electrical equipment, appliances, and components surged 1.3%. There were also gains in orders for primary metals, fabricated metal products, and defense aircraft. Shipments of manufactured goods increased by 0.7%, the biggest gain since August, after falling 0.6% in December. The stock of manufactured goods at factories remained unchanged after rising 0.4% in December. Unfilled orders at factories remained unchanged as well, as a jump in unfinished work for computers and related products was offset by decreases in consumer goods. The report from the Commerce Department followed an Institute for Supply Management surveys showing that manufacturing, which accounts for 11.3% of the economy, contracted for a fourth straight month in February. However, the pace of decline slowed and new orders improved for a more than 2.5-year low. The rebound in shipments of manufactured goods bodes well for future production, but it could chip away at gross domestic product this quarter. Manufacturing is being undermined by the dollar's past appreciation against currencies of the of the United States' main trade partners and softening global demand. With the Federal Reserve expected to continue hiking interest rates into the summer, a quick turnaround in manufacturing is unlikely. So, good news, bad news. There's a lot of that going around these days. All right, and then last up, I got an article here from our friends at Zero Hedge. Goldman expects nearly 1 million drop in tomorrow's job openings. So let's see what they had to say. In a recent speech, Fed Chair Powell warned that if economic data continued to come in as strongly as it did in February, the Fed may resort to 50 basis point or higher rate hikes at the next FOMC meeting, which is scheduled for, I think, March. The barrage of upcoming economic data, including ADP and JOLTS reports, non-farm payrolls, CPI, PPI, and retail sales, will closely be watched to see if it confirms January's outlier data or shows a return to more typical levels. However, previous analysis have suggested that January's data may have been artificially inflated, with retail sales showing a sharp slowdown after the January splurge and layoffs/initial claims data being propped up by state-level WARN notices. A new report by Goldman Sachs chief economist Jan Hatzus suggests that the JOLTS job openings measure is also delayed or rigged, with the official data no longer representing reality. Goldman predicts a large pullback in official job openings in the U.S., with job openings forecast to fall by 800,000 to 10.2 million in the January JOLTS report. This drop could quickly reprice much of the recent tightening, driven by expectations of no landing, with the terminal rate at 5.65% and the 2 and 10s below 100 negative 100 basis points. Morgan Stanley also expects a renormalization of economic data, starting with payroll prints, which will likely be lower than January levels due to seasonal factors, warmer weather, and changes in corporate behavior relating to labor hoarding. The economy will need to add close to 800,000 jobs in February for seasonally adjusted payrolls to net zero, while in January, anything less than 3 million job losses would have delivered a positive number. Overall, the upcoming economic data will closely be watched to see if it confirms the strength seen in January or shows a return to more typical levels. However, previous analysis suggests that January's data may have been artificially inflated, with a potential large pullback in job openings, leading to a repricing of expectations and a more realistic view of the state of the economy. All right, so our friends over at Goldman Sachs seem to think that the folks at that report all these numbers are fudging the numbers to make it look better. So not that I would be shocked that a government employee would do something that devious. Never. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope everyone has a wonderful evening, and I'll talk to you next time. Adios.